All right, Spruce Point Capital founder and CIO Ben Axler, welcome back on.
Hey, thanks for having me. I think maybe last time I was on, we were talking about Skechers and some of the warnings we saw with the sneaker companies, and the news on Nike today sort of foretold some of the streams we saw in the segment.
Yeah, those high inventories definitely not something that you want to be seeing continuously, especially in something like a shoe company. So let's get into now Broadridge. Of course, the first thing I want to ask more is first tell us about what Broadridge really does and why you don't see it as a SaaS or fintech company.
Sure. So Broadridge is an old line company, been around for a while, spun out of ADP in 2007. They're thought of as sort of a backbone player in the financial service industry. So if you own a mutual fund, there's certain regulatory filings that a mutual fund has to provide. So they'll help distribute, those documents. Likewise, if you're a stock owner and you get a proxy statement, they have a proxy service business to make sure that you get those financial documents. But the issue that we see here is, at the core, these are fairly low margin businesses. I mean, printing and distributing documents is not a fintech business. It's what we consider a business process outsourcing company. And, if you look at their gross margins, I think that's where the rubber hits the road. If you were a fintech or in a high quality, software as a service fintech, you would be doing gross margins of 70% or 80%. Here the company does about 28%. Likewise, they talk about their recurring revenue. Why do they call it recurring? Well, mutual funds have to every quarter, every year, every semi-annual produce these documents. So it's sort of recurring. But, our contention is it's not high quality recurring because there's no pricing power. A lot of the prices and the fees they get are regulated. And so there's no inflationary adjustments here. It's mostly a volume business, and they don't carry a lot of deferred revenue like you would expect a SaaS company. So, we think, again, there's a misperception here of them claiming to be a high quality fintech, SaaS-like business, and we kind of see it the opposite way.
Also stated in the report is a shrinking ecosystem. What seems to be showing up here that seems to be getting unwrapped?
Right. So, consolidation, is a negative for them. And what we see is increasing customer concentration. And we also see them changing a little bit their disclosures. And we can talk about some broader issues there, when companies start to change the goalposts or the metrics or the disclosures they give, that's generally a red flag. But, the industry has shrunk. As you can see, there's fewer corporate issuers than there were a number of years ago. There's fewer institutional investors. There's fewer broker dealers. So, consolidation from a financial service industry and a more concentration of customers gives your customers more leverage over you. And that's one of our big concerns.
Now, one major flag that is pointed out in the report, and I'd have to agree, it seems like a red flag for myself also, is the mention of the multi-year suspension of free cash flow. Yes. And also the CFO resigned, right? And so correct. Why is this a red flag to Spruce Point? And why should we be really worried about kind of getting that suspension of free cash flow off?
Correct. So he resigned in 2020. And that year, the cash flow guidance that they give, they missed it incredibly by like 20%. And then, going forward, they suspended it, but the cash flow has been going down. And that we think is tied to a project they announced with UBS. And UBS is a material customer. And UBS, is a big financial service company. But in particular, they tied their fortunes to the wealth management business at UBS. And UBS's wealth management business, their advisors have been shrinking over time, and they have partnered with them to build out a new wealth management platform. Okay, and that project we believe has taken much longer and cost significantly more money than they expected. And the company won't disclose, and this is a red flag. They will not disclose how much they've spent on the UBS project, but we can estimate it at about $1 billion. And we think, based upon some revenue projections of $70 million a year that they get from UBS, and we run an MPV analysis, we think that project's underwater, meaning they'll never be able to recoup that investment. So they need to impair it and start expensing the incremental costs. And if they were to do that, their EBITDA would go down, and we believe they would trip a debt covenant.
That's interesting there. Now, I did see a bunch of revisions being mentioned in the report. Can you tell us a little bit about this and why we should be concerned?
I'm sorry, which revisions specifically?
So I see a bunch of revisions. I mean, yeah, it's not like it's one, but there is a bunch of revisions made in the TAM. I saw the TAM get changed. I saw also percentage on what the allowance adjustment. And so tell us a little bit about this.
Right. So one of the key metrics that management often talks about is their closed sales. And they like to say, we've closed, call it 300 million of sales this year. And they, they then, just because they close a sale doesn't mean they book a revenue. And in fact, we saw this with the UBS in 2018 when they announced the partnership. Included in that closed sales number was about 40 million of UBS revenue. But guess what? It's not going to be until 2023 until they actually book revenue. So we have some concerns about that closed sales metric. They also have to make an allowance for closed sales that won't convert. And if you look historically, that allowance keeps growing and growing. Meaning that historically fewer and fewer of these closed sales are actually converting to revenue. They've also stopped disclosing a portion of their backlog. The TAM revision is also an important one too. They recently, just in the past couple of weeks, increased their TAM by 15%, and they didn't give any justification why. And it makes almost no sense because here we are headed into an economic recession, and they're not recession-proof, but yet they're claiming their TAM is growing. So it's challenging. We're trying to challenge the underlying assumptions that management is putting out, challenge the numbers. And we see a lot of holes in the numbers, whether it be the TAM or the quality of the closed sales metrics that they present.
Now, another thing that clearly is stated in the report is their recent levered acquisition, right? Can you tell us a little bit about this acquisition and how they're kind of giving some lofty expectations that you guys don't see will actually come to fruition?
Correct. So, this is a big issue that we're going to see this time in this economic cycle versus previous ones. So, Broadridge historically, again, thought of as a defensive company, sort of in the financial plumbing network, but they've generally carried no debt. Now they levered up, put over $2.2 billion of incremental debt on the balance sheet. And they paid 10 times revenues for a Swedish company called Activity, which was only growing mid-single digits, to expand into front office capital markets software connectivity. Again, capital markets slowing down. They bought a business tethered to something that's not economically insensitive. But here we are now, headed into a recession. They have a record amount of debt. They have a record low amount of cash. They've been growing their dividends, so they have a record low amount of excess free cash flow to pay down this debt. And so, the operating cost structure of the business has risen. So, we warn investors that maybe 10 years ago this was more of a defensive business, but now you have a lot of debt on it, right? And you have slowing growth. We have evidence that they're losing customers. They've retracted a core metric they've given called recurring customer revenue retention, which was at sort of like 98%. They no longer state that in their SEC filings. So we see evidence of them losing customers. And so we think this time around, this is less of a defensive company, and investors are going to need to brace for more downside given the leverage.
Now, stated in the report also is a high likelihood of that Broadridge is under regulatory scrutiny from the SEC. Why do you guys feel this? I did see the letter that was stated there that they received SEC comments questioning the disclosure of the closed sales. And then a response came to the SEC that just caused a little bit more questions on the CFO. What happened here?
Right. So they did, in fact, get an SEC comment letter. But we took a more holistic view to kind of see what's happening with the personnel changes, what's happening with some of their policies and programs. And one of the things that got us very concerned was looking at their code of ethics policy. They've made 4 revisions to it since right around the time when the CFO left. And each time, they're using a little bit more worrisome language, including the word fraud in the policy. And in the latest iteration, giving explicit guidance about how to deal with a regulatory inquiry. Like if you get a call, don't answer, direct it to the legal department. So you kind of see things like that. You also see a change to the clawback policy, meaning that, if there's a financial accounting restatement, that they can take back money from executives. That was just added, that emphasis on accounting restatement. There's also a third party in the market called Probes Reporter. And, we recommend people go to that website. He specializes in filing freedom of information requests with the SEC. And based upon his analysis, he put Broadridge on his watch list, believing that they've had an SEC investigation. So, there's a number of data points. It's kind of like reading the tea leaves, but, given everything we're seeing here, we think there's definitely a high likelihood they've come under SEC scrutiny.
So I'll just say it how it is. Why is Broadridge overvalued?
It's trading at almost 4 times revenues. It's 16 times EBITDA. But, that in our view puts it, sort of on par with financial technology peers. But again, 40% of this business we think is tied to low margin to no margin, just business process outsourcing, like printing and distributing proxy statements or credit card statements. So they actually they work with American Express. If you have an Amex credit card, they're the ones, distributing the printed monthly statements. I mean, again, not great business. 40% of the revenue is tied to that. So we value 40% of the revenue at a very lower multiple, a 1 to 1.2 times revenue multiple, consistent with other business process outsourcing printing companies. And then on the quote unquote technology piece of the business, we put a slightly higher multiple of 2.5 to 3 times. And you value the sum of the parts there, and we get 65 to 75% downside risk.
Now I'll leave you the floor here to make any comments on any of the other short reports that you guys have put out, or any other concerns that you have on Broadridge that you'd like to mention.
I think the biggest concern is, look, we put out a pretty pointed report that one would think the management would want to get ahead of and respond to and discredit or kind of refute some of our key findings. And we've heard nothing at all from the management. So if I'm a shareholder, I'm thinking, well, why aren't they defending? Why aren't they defending themselves here? So that the silence is pretty deafening. And so we would like to see, obviously, if we're wrong, for the company to tell us where we're wrong, because we certainly would fix our conclusions if we were proven wrong. So that's a big concern. Otherwise, again, I think if you look at our recent calls, many of them are playing out. We also talked about Skechers, which is moving lower, obviously, in weak numbers from Nike. We also warned about Generac, if you recall, the standby power generator company. Even despite a big hurricane, which generally stimulates demand for backup power, the stock's still under pressure. We kind of warned that they have no capacity and that their alternative energy business is under pressure. They lost a distributor subsequent to our report, and Generac's hit a new 52-week low. So I think, we're broadly consistent with all of our reports. We stick to our guns. We certainly are going to be sticking to our guns on Broadridge, and we hope to have a follow-up call with you and report back that the stock's down 50% or more.
Hey, we'll definitely wait and bring you back on like always, but we'll see how the story plays out. I do got to say that you guys give an expansive report there. So if you guys out there want to go ahead and look at it yourself as investors, take a look. 81 pages. It doesn't seem like it was something that was taken lightly, and an extensive report there that you guys given. So I appreciate you coming on today, Ben Axler, Spruce Point Capital Management founder and CIO. We'll definitely have you back on, Ben.
Thank you. Have a great weekend, everyone.